One of the things that's really difficult about transitioning an HVAC, plumbing, or electrical business to the next generation, to a son or daughter, is getting killed in taxes on the transfer. But if you don't make that transfer, then the son or daughter is oftentimes not as eager to take over operations because their name's not on the door. They don't have ownership yet. And so one of the ways that we can structure this to solve this problem, right, is to remove the assets from the business and to just sell the operating business. So what the reason this works is because typically with an HVAC business, right, you have a business like this, right, and then you have lots of stuff in it, right? So you have your operations, you have your service contracts, right? You have your employees getting paid out of it. Maybe you have a retirement plan, right? And then you have trucks, right? And buildings. Maybe you've bought a shop or whatever. So you have all these things into the business. And so what happens is these assets you take depreciation on, right? Those are deductible. But if you sell this business as a whole, right, you're going to pay capital gains on the difference between your basis in the stock, right, which is generally pretty close to zero if you're using it for income, um, and the stock price that you sell it for. And then included in that is generally, depending on how you set it up, right, the basis in these assets and their sales price, right? So you can just sell like the stock straight up, or you can sell like the individual assets and the operations as well. Either way, you're looking at capital gains tax on that transfer. So what we typically do instead is we look at an opportunity to kind of separate these things out. And the earlier we can do this, the better, because sometimes it can be hard to get the assets out of there, just depending on the tax basis of them. But we have one business, right? That's the operations of the business. You pay your employees out of here, service contracts go in there, all that. And you can sell that or transfer it to a son or daughter. You can really do it over time. If you do it over time, you can do it within gifting rules and actually transition the whole business over to them tax free if you do it right. You'd want to be careful on how you do that. But then over here on this other business, which is typically an LLC, a disregarded entity, you have all of your assets. And so with the assets over here, what happens is we'll have the operations account pay rent to the asset business. The senior or the parent can own this business. They get some passive income from it. And then if they pass away, when they pass away, the heirs, right, the sons or daughters, will get these assets with a new step up in basis. So instead of paying capital gains tax when you sell a $2 million building, their basis in that building would be $2 million or whatever the value is when the parent passes away. And so it's a great way to transfer the assets of the company to the heir without paying a lot of tax. Meanwhile, the value of the operation side of the business typically pales in comparison to the value of a shop or a fleet of trucks.